What is an annuity? People have this idea that annuities are complicated, but they're really not, and I'll show you. Now, if you stick with me to the very end, you'll get an invitation to my free masterclass what the US government and Wall Street don't want you to know about saving for retirement. It's a real eye-opener. I go over alternative ways to save for retirement that outperform your 401k in so many ways. Please subscribe and hit the bell to be notified every time I upload a new video. Annuities can be traced back to Roman times and have been available in the United States since 1812. The first time commercial annuities became available to the public began with the founding of the Pennsylvania Company for the Granting of Annuities. In 1905, Andrew Carnegie founded the Teachers Pension Fund, which in 1918 turned into the Teachers Insurance Annuity Association. But I'm going to be very honest with you, annuities have a really bad rap, and it's because of the reputation of variable annuities, which are risky and expensive. With a variable annuity, your money is in the stock market, and your money is at risk to stock market losses. And they're also just loaded with fees. So this is why you hear people like Susie Orman, Dave Ramsey, Ken Fisher, your financial advisor, your CPA, your brother-in-law say annuities are bad. They're also complicated. And the only thing bad about annuities, besides variable annuities, is that bad agents will take advantage of your ignorance by putting you into a variable annuity just to get a bigger commission. So I'm going to get this out of the way right now because I don't recommend them. I have never sold a variable annuity, and I never will. So if you're interested in a variable annuity, I am not your lady. So moving on, there are 3 types of annuities, but obviously I'll only be addressing fixed and indexed annuities. Fixed annuities pay a fixed interest rate, and indexed annuities pay based on the value of an external index, and I'll get into that later. So an annuity is a contract between the investor, otherwise known as the annuitant, and the insurance company. The funds used to purchase an annuity are called a premium, and those funds can be qualified or non-qualified. And I'll go over that later too. The insurance company will take that premium and invest it in safe investments. An annuity offers a moderate interest rate better than a CD or bonds. And people acquire an annuity because they either want a guaranteed income for life, for a certain period of time, or a specific return on their money. Life insurance is all about risk, and this is the likelihood that an insured event, in this case death, should occur throughout the duration of the policy term. If you want a lifetime income, the payment amount is calculated based on the number of months between your current age and your life expectancy age. So if you are 65 and your life expectancy age is 80, the payment amount is based on 180 months. If you live beyond your life expectancy, the monthly payments continue. Before we move forward, I want you to understand the different ways that you can fund an annuity. And that would be the difference between qualified and non-qualified money. Qualified money is money from a tax-deferred account like an IRA, 401k, 403b. Non-qualified money is money you've already paid taxes on, like a Roth IRA. So going forward, I'll refer to these monies as qualified or non-qualified. So there are 2 ways you can fund an annuity. You can fund it with one single lump sum premium or multiple premiums. An immediate annuity, also referred to as a SPIA, single premium index annuity, differs from a deferred annuity, also referred to as a DIA, or deferred indexed annuity, in that they do not have an accumulation period. They're funded with a single lump sum payment rather than a series of premium payments. You would choose an annuity option, and the distribution period begins within 1 to 12 months after the purchase. Because the funds in the immediate annuity have not had time to build interest, income payments are lower than a deferred annuity. Also, if you fund this annuity with qualified money, the income you receive from the annuity will be fully taxable as ordinary income. If you fund an annuity with money you've already paid taxes on, you would only pay taxes on the interest you've earned. One risk of immediate annuities is being locked into current interest rates when the current interest rates are unusually low, just like they are today in 2020. Should interest rates rise over the period of time during which the annuity payments are made, those annuity payments will not reflect that rise. Locking in the annuity interest rate is just part of the cost. Now, if you do wait until a later age because you're still working or have other sources of income such as a 401k or Social Security, you don't want to tie up all or even most of your money in an income annuity, because once you convert it to income, it belongs to the insurance company. And keep in mind that annuity income is a fixed income, which means it will lose purchasing power to inflation over time. Investing in an income annuity should be considered as part of an overall strategy that includes growth assets that can help offset inflation throughout your lifetime. So let's say you invest $200,000 in an immediate annuity, and the contract provides for a 5.63% annual income. But after 20 years, the annuity is fully depleted. The insurance company will continue paying you the agreed upon annual income benefit, in this case, $938 a month. So deferred annuities are designed for long-term savings. Unlike an immediate annuity, which starts annual or monthly payments almost immediately, investors can add funds at any time and delay income from a deferred annuity indefinitely. The income payments from a deferred indexed annuity are typically higher than for an immediate annuity because the funds have had time to accumulate interest. A fixed annuity is also sometimes referred to as a MIGA, multi-year guaranteed annuity. It has a fixed interest rate that is applied to invested funds for multiple years in a row. It's best if your time horizon is 3 years or longer. If less than 3 years, turn to a CD. It's not recommended long-term since interest rates change frequently. And at the end of the contract, you can either convert that to a guaranteed income stream for life, or you can take the money out and just walk away with it. First, I want to compare the market strategy and the indexing strategy, so just keep in mind a couple of things. The market strategy is an investment strategy where your money is in the stock market. So you have your money with an investment advisor in a 401k, a 403b, or an IRA. The indexing strategy is what I'll be teaching you. Now, before I address index annuities, it's important you understand what indexing is. So with indexing, you would choose an index like the S&P 500. Your money is not invested in the index, so it's not in the stock market, but you get the return based on movement of the index. Your money grows however the index performs, up to a limit or a cap, for example, 12%. Now, if the market grows 15%, your money will only grow up to that 12% cap. But the trade-off is complete downside protection from market losses. So just like you would have a cap, you would also have a floor of 0. So the worst thing that could happen is you get no interest in market downturns. In other words, you lose nothing ever. Indexing gives you the ability to grow your money at a decent rate, historically 7 to 8% annually, and be protected from market downturns. There are no contribution limits, no age restrictions, and for the most part, you have access to your money, and there are minimal to no fees. Take a look at this chart, which shows you the difference in the market strategy and the indexing model. The red line is the S&P 500, and you can see how volatile it was between 1998 and 2013. The blue line is the floor or the guaranteed return on the indexing product, and the green line is the indexing strategy. So you can see that when the market goes down, you get zero growth because of the floor. You can also see that if you had your retirement savings in an indexed product, you would have lost nothing in the last recessions, and you would have been ahead versus any 401k. This is another comparison of the market strategy and the indexing strategy. At a 12.5% cap with a $100,000 balance over the last 20 years, if you had just gone to sleep and put your money into the indexing strategy, you'd actually have $153,000 more in your account with a cap and a floor than you would have just writing it out. Now that we understand indexing, let's talk about index annuities. With an index annuity, you would choose an index like the S&P 500 or a combination. Again, your money is not in the stock market, but it grows however the index performs up to a limit or a cap. At some point, payments will be made to the annuitant, and the amount of those payments depend on how long the insurance company has to invest the premium before income payments begin. Fixed and indexed annuities have zero fees and zero expenses, unless you add an income rider at 1%. And that's not necessary until you want to start an income stream. Even just a few years ago, these were not the best products, but this annuity is a new innovation. Some are even uncapped with unlimited upside, and some companies will give you a bonus of 7 to 10% of whatever you deposit. But the sacrifice you make with that is a lower cap rate. Most importantly, if this annuity is not structured properly, they can be very expensive. Now, a fixed annuity provides the advantage of a guaranteed rate of interest, where an indexed annuity combines a guaranteed minimum return plus the potential of higher earnings if the stock market does well. I'll give you an example of how my mom recently chose a fixed annuity. My dad recently passed away, and because my mom is 90 years old and almost completely blind, I've been helping her with her finances. A statement came in from Edward Jones, and in just 1 month, they lost an eye-popping amount of money. So considering that my mom doesn't need this money, it's basically my sister's and my inheritance, she wanted to protect it from further losses. This is just like at the very beginning of the coronavirus. So she chose a fixed annuity with a guaranteed interest rate of 3.5% for 7 years over an indexed annuity because my mom feels certain the stock market is going to crash. And a guaranteed 3.5% interest is better than a guaranteed zero floor of an indexed annuity. So if we weren't experiencing guaranteed market volatility for the next year or more, she would have probably gone with an indexed annuity. Now, just to give you an example of a bad agent or investment advisor, but when my mom's financial advisor called to ask why she was taking her money out and putting it into an annuity, she told him she doesn't want to lose money in the next market crash, which she feels certain is going to happen soon. And he actually said to her, and I know this because she had him on speaker, "If you lose money, it'll come back eventually." Literally, my jaw dropped. She told him, "Yes, but I'm 90 years old." That is not a fiduciary. He was putting his interests before my mom's. And I think he thought he could take advantage of a 90-year-old woman whose husband just died. But my mom is sharp as a tack. This guy, if he were to sell my mom an annuity, would probably have sold her a variable annuity or an indexed annuity because he would get a much bigger commission. So you gotta be careful. I mean, these people are everywhere. You can't tell a book by its cover. Bad agents and financial advisors don't necessarily look that part. Okay, so there are 0 fees with an annuity unless you add an income rider at 1%. The insurance company pays the agent a variable commission for selling the annuity to you, and they factor that into their contract pricing. Commissions are not deducted from your premium. That's because the insurance company is counting on you leaving your money with them long term. If you don't keep your money with them long term, or if you want access to more than 10% of your money in any given year, you will be charged a surrender charge. And this is just one of the ways they can pay agent commissions without charging you. Surrender charges usually start out at 10% the first year, 9% the second year, and so on. That being said, the surrender charge would be waived under the following circumstances. If you require home health care services as a result of not being able to perform 2 out of 6 activities of daily living, like bathing or dressing, if you're diagnosed with a critical or terminal illness, or if you're confined to a nursing home for at least 60 consecutive days. Now, before we move on, I just want to quickly go over a few popular riders. And these are like add-ons to your policy. But you do pay fees on these riders. With the lifetime income benefit rider, the insurance company guarantees that you will receive regular income payments from the annuity, whether that's monthly, quarterly, or annually. The payments will continue for the rest of your life, even if the actual balance in the annuity is fully depleted. A lifetime income benefit rider can ensure that you never outlive your money. For example, let's say you invest $200,000 in an annuity. The contract provides for a 5% annual income, but after 20 years, the annuity is fully depleted. The insurance company will continue paying you the agreed upon annual income, in this case, $10,000, for the rest of your life. One of the most common disadvantages of annuities is that they are established as living benefit contracts. That is, they provide you with income benefits for the rest of your life, but once you die, there's no insurance benefit for your heirs. And this can be an obvious disadvantage if you purchase an annuity with the intent that it will provide income for you for 20 years, but you die after just 10. The remaining funds in the annuity contract will revert to the insurance company. And since you are only halfway through the expected term of the contract, that's going to be a substantial amount of money. The death benefit rider gives you the ability to provide a death benefit for your heirs in the event of your death, converting the annuity to both a living benefit and a death benefit. A death benefit rider guarantees your heirs will receive at least the amount of the premium you paid for the annuity. For example, if you paid $250,000 to establish the annuity, and as of the date of your death, only half of the premium has been returned to you, your heirs will be entitled to a death benefit of $125,000, and that's tax-free. As people are living longer, providing long-term care has become a growing concern. But the basic problem with long-term care is that it's really expensive. And not only that, but there are a decreasing number of insurance companies that provide policies to cover long-term care. But you can add a long-term care rider to an annuity, so you'll have the contingency covered within your plan. The annuity will provide the income specified in the contract, but will also pay a long-term care benefit in case it's necessary. What the long-term care rider does is it adjusts the income payout to help accommodate the cost of long-term care. For example, let's say that the cost of long-term care will be $6,000 a month. If the annuity is scheduled to provide you with a monthly income payment of $3,000, the payment will double to $6,000 per month in the event you have been medically determined to require long-term care. A long-term care rider usually provides a benefit that will be double the normal income payment from the annuity. All right, so let's look at the differences between your 401k and an annuity. By the way, you should absolutely watch my video 401k fees exposed up here. With an annuity, you get a lifetime income no matter how long you live. There's no income with the 401k. Annuities have no fees or expenses unless you add a rider, and your 401k is loaded with fees. Both grow tax deferred. When you die, your beneficiary will only pay taxes on the difference between the principal and the current value of the account. But your 401k will be taxed twice. Once when you die, death taxes, and again when your beneficiary accepts the proceeds, inheritance tax. And lastly, both will pay a penalty if you take a withdrawal before the age of 59 and a half. But with an annuity, you will not be penalized if you are chronically, critically, or terminally ill or disabled. Now, when you purchase an annuity, there is a right to examine or a free look period, which is usually between 10 to 30 days, just depending on what state you live in. This gives you the right to return your policy for a full refund for any reason, no questions asked. Afterwards, you can cancel the contract at any time, although doing so will likely cause you to incur a surrender charge. Annuities are not FDIC insured, but compared to commercial banks and investment firms, life insurance companies' solvency record has been nearly faultless, even during hard economic times. A large percentage of the life insurance companies that exist today have been around for well over 100 years. In the 2008 financial crisis, only one life insurance company became insolvent, and that was AIG. At the same time, 465 banks failed. And instead of federal regulation, each individual state has an insurance department who's responsible for enforcing strict regulations on life insurance companies. One of the strictest and most important requirements is the dollar-for-dollar reserve requirement, where the company must keep at least $1 in reserve for every $1 in guarantees they've made to contract owners. So an insurance company must have in savings at least as much as it would take for every single contract owner to walk away with the current value of future obligations of those contracts. It's also important to note that banks and the federal government are not required to keep such reserves. A large bank is required to have only 10% in reserves for every $1 deposited. On an annual basis, state regulators